morning, everyone, and welcome to the ECB Banking Supervision press conference with Andrea Enria, the chair of the Supervisory Board. Mr. Enria will make some opening remarks and then we will take your questions. There will be some slides which you will be able to see on the screen, and then we will go to your questions. The statement is published on the website, as are the results of the Supervisory Cycle 2020 and also the Supervisory Priorities. So without further ado, I will give the floor to Mr. Enria.
Thank you, Connie. Welcome to our press conference on the Supervisory Review and Evaluation process, the SREP. I remember last year when we did the first conference on the SREP, in the preparatory meeting, a colleague asked me what would I have answered to a question on the potential impact of this virus that was developed in the Wuhan region in China. I say, I hope that they don't put the question because I wouldn't know how to answer. And luckily enough, there was no question, but that's what the issue, of course, we were grappling with for the full year. So today I will try to cover briefly 4 topics in my introductory remarks. First, the extraordinary features of the crisis. Second, the resilience of the euro area banking sector in 2020. Third, the major vulnerabilities that we have identified through our monitoring and our pragmatic SREP. And fourth, our supervisory priorities and the outlook for the euro area banking sector going into 2021. So uncertainty has been the defining feature of this unprecedented shock. In the initial phase of the pandemic, macroeconomic uncertainty reached levels never before recorded, with fast implementation of social restrictions and economic support policies and plummeting levels of business and consumer confidence. This left all economic agents, including banks, virtually unable to make projections 1 or 2 years into the future. Uncertainty abated somewhat in the course of 2020, as shown by the fact that the ECB projections in December were closer to the ones in September, and also the distance between the central and the other scenarios narrowed down. Still, under the baseline scenario of the December projections, the GDP will drop by more than 7% in 2020, and the economy will only return to the pre-crisis level by mid-2022. And if the severe scenario were to materialize, the economic rebound would be delayed until 2023. Financial markets have been distressed, although less so than during the great financial crisis and the subsequent sovereign debt crisis. And unlike those crises, in this case, the shock was not generated by financial markets or by banks' behavior. And many have pointed out that this time banks are not part of the problem. But there was a serious risk that they could aggravate the problem, that they could react to the shock with a sort of knee-jerk reaction, with a spike in risk aversion, a sudden tightening of credit conditions that could have aggravated the recession. In order to make banks part of the solution, a wide range of public policy measures were adopted to motivate adjustments in behavior and avoid procyclicality. When the pandemic shock first hit, business companies, banks, and other organizations, including us, scrambled to reprioritize activities to safeguard health, of course, while attempting to minimize disruptions. Lockdown measures imposed across Europe forced the banking industry, as well as other businesses, to implement remote working measures. In March and in April in particular, banks focused on implementing operational contingency plans and creating capacity to serve their customers. Given these exceptional circumstances, the ECB adopted a pragmatic approach when undertaking its annual core activity, the SREP, also in line with what the EBA, the European Banking Authority, indicated. During the 2020 SREP cycle, we focus on how banks are handling the challenges and risks to capital and liquidity arising from the ongoing crisis. We decided to keep the Pillar 2 requirements, P2R, stable, except where individual banks were affected by exceptional circumstances which justified changes. And the Pillar 2 guidance, P2G, has also remained stable as a reflection of the postponement of the stress test of the EBA that will start shortly. Moreover, we have not updated the bank's SREP scores unless justified by exceptional circumstances affecting individual banks. We mainly communicated our supervisory concerns to banks through qualitative recommendations, and we alleviated the burden on banks with a more measured approach to collecting the data on the ICAP, the Internal Capital Adequacy Assessment Process, and the ILAP, the Internal Liquidity Adequacy Assessment Process. Now, European banks were in much better prudential shape when the pandemic shock hit than they were when the great financial crisis started. This can be attributed both to the regulatory reforms that we undertook during these years, and also by the fact that in the last 6 years there was a lot of effort by the single supervision within the banking union to bolster the resilience of the banking sector. At the entry point, at the end of 2019, the Common Equity Tier 1 CET1 ratio was 14.9%. In order to counter the effect of the COVID-19 shock, national governments and EU authorities deployed measures of unprecedented nature and magnitude to support banks and the economy, including large and coordinated fiscal and monetary expansion, as well as loan moratoria and public loan guarantees. As microprudential supervisors, we encourage banks to adopt transitional IFRS 9 requirements to smooth the impact of provisions on regulatory capital. We brought forward the 2021 requirements under the Capital Requirements Directive, the CRD5, on the composition of P2R, which are less demanding in terms of CET1 capital. And we declare that banks could temporarily operate below the level of P2G, so that the supervisory buffers could be used to withstand the shock. And that this would have been in place, this possibility would have been in place until at least the end of 2022. And where needed, we say that banks would also use the so-called capital conservation buffer. So we gave ample space for banks to use their buffers. Several macroprudential authorities also lowered or suspended the buffer requirements in their remit. Taken together, excluding the flexibility on the capital conservation buffer, these measures almost double the bank's capital headroom from 2.8% to 5.3% as of the third quarter of 2020. And our estimates, of course, do not include the alleviation which has been provided by the so-called quick fix of the Capital Requirements Regulation, or the CRR, which lowered the risk-weighted assets and therefore provided further space for loss absorption. Such a unified and prompt response would have been unthinkable before the banking union and European banking supervision were set up, when supervision was segmented along national lines. Going into 2021, ample room for loss absorption is available to all banks under our supervision, especially considering that the buffer flexibility we have granted includes the capital conservation buffer and remains valid until the end of 2022. Since the third quarter of 2020, banks under our supervision have been well capitalized. Only a few banks have dipped into their buffers so far. As credit losses from pandemic are yet to materialize, this is likely to be a consequence of idiosyncratic and structural issues rather than of the COVID-19 downfall. I will come back to this point in a moment. It would be premature, in my opinion, to see the fact that banks have not freely used these buffers as an indictment of the Basel framework's effectiveness in this regard. So I know that there have been proposals to significantly reform the framework because it seems that the buffers are not really used, but I think it's a bit early to say, and we need to wait until the pandemic-induced losses start materializing. When this happens, and where necessary, I would encourage banks to make use of all the loss absorption room made available to them, and not to refrain from implementing an early and accurate risk management strategy due to capital concerns. So not to protect capital, but to actually accurately measure the credit risk in their portfolios. Thanks to the COVID-19 ad hoc reporting developed by the EBA, we were able to monitor operational performance of the banks. We supervise on a monthly basis. We set up a COVID monitoring task force drawing on expertise from all across our organization. and in order to focus and work quickly to identify points of stress. This gave access to us to real-time information about the effects of the pandemics on the banking sector and enabled us to prepare ourselves to address concerns. Our staff, of course, was subject to the same constraints as many people across Europe, and we had to implement wide-ranging teleworking arrangements. This did not impair our ability to conduct effective supervision. We shifted also for our on-site activities to more off-site modes. We increased our collaboration between teams, also with the national authorities. We had daily alignment meetings where all top management met and made the point of the situation. Our joint supervisory teams, the JSTs, increased the surveillance touch points with the banks they supervise, and the flow of information between the supervisory and the monetary policy side of the central bank of the ECB also were intensified. Our new ways of working proved effective in delivering the necessary information and data analysis, and this also reflected the ability of banks to provide this information promptly to ensure business continuity despite lockdowns and with limited disruptions. The situation also highlighted the opportunities for cost savings across the sector, as banks showed that they could continue to operate despite temporary branch closures, a point I will come back to later. But what matters most is that we have so far averted excessive procyclicality. Lending to firms and households continued to grow in 2020, even though we saw a slowdown in the third quarter. And compared with what happened during the great financial crisis, last year banks reported a much more moderate tightening of credit standards. If we dig a bit deeper into the lending data, the trend reversal in the third quarter of 2020 seemed to be accounted for by the business euro area banks, banking groups conduct outside of the euro area. So this is evidence of a slight international retrenchment in lending, which unsurprisingly is often a characteristic of recessionary shocks. In this specific case, the asymmetry in lending developments inside and outside the banking union may also be explained by the level of public support deployed within the euro area, especially in the form of loan guarantees. We've seen recently that the ECB published the new bank lending survey data that showed that in the fourth quarter there was a further tightening of standards. Our monitoring and the pragmatic SREP identified credit risk, profitability, and internal governance as the main areas of supervisory concerns. Many governance findings from last year are still outstanding, also because we suspended the follow-up actions. And almost all significant banks, 80% of them, were addressed with credit risk recommendations. And the number of findings concerning credit risks increased by 79%. The number of findings concerning business models rose even more strongly by 105%. To some degree, the lag in the reaction of NPLs, of non-performing loans, is to be expected, and the increasing cost of risk, a measure of provisioning, is a sign that banks are preparing for asset quality deterioration. But over the course of 2020, we did develop specific concerns about identifying, measuring, and managing credit risk by banks. We promptly communicated these concerns in letters to bank CEOs in July on operational preparedness to tackle the deterioration of asset quality, and in December of 2020 on credit risk, more specifically on credit risk management. Within the SREP, we have taken qualitative measures in the specific areas I've just described. Clearly, asset quality deterioration remains our main concern for 2021, and this is a supervisory priority we will follow on. The evolution of provision in 2020 confirms the market consensus. With their provision in the second quarter, banks absorbed most of the cost of risk they envisaged taking on due to the pandemic. But our expectation is that the social restriction policies that became necessary during the last quarter of 2020 and that are still in force right now will demand additional efforts from banks. We will monitor these efforts closely, and we expect them to be reflected in the data for the fourth quarter of 2020 and going into 2021. Data for the third quarter of 2020 confirm a concern we already flagged in December. The way in which banks are preparing for asset quality deterioration varies widely and could in some cases be insufficient. Stage 2 classification increased to a limited extent for many banks in the sample, showing a tendency to refrain from identifying significant increases in credit risks within the loan book. For several banks, this has been coupled with low increase in provisions, which remains a point of supervisor attention. This observation is shared by our colleagues on the central banking side. Banks' provisions appear to fall below the level observed in other jurisdictions, such as the US, below the levels reached in response to the financial crisis, and more generally, below the levels predicted by historical elasticities to macroeconomic developments. Some of the aggregate evidence on under-provisioning may be explained by the unique features of this crisis, including in particular the unprecedented public support, the specific role of savings, which have increased a lot in relation to disposable income during the pandemics, and the negative impact of COVID-19 being concentrated in specific vulnerable sectors. Nevertheless, we must remain vigilant to banks' practices potentially leading to under-provisioning. Back in November 2020, we identified that some IFRS 9 model on probabilities of default had become far less sensitive to changes in GDP, which might indicate that banks have implemented model changes, aimed at artificially reducing the measurement of credit risk. I mean, this chart seems a bit confused, but it's particularly interesting, I think. We plan to monitor developments in this area, as these interpretations may account for our finding that 2020 provisions were lower than historical elasticities would predict. In our letters to banks in July and December 2020, we emphasized the importance of identifying borrowers' financial difficulties at an early stage. In our view, it is crucial that banks consider all available evidence and reflect on developing new alternative credit risk indicators which factor in the pandemic environment and the deployment of broad-based moratoria. Several authorities and standard setters, including ourselves, have stressed that moratoria and other forms of COVID-19 related forbearance should not be taken as justification to postpone the assessment of unlikely to pay conditions. So the fact that you don't see the payments coming because of moratoria should not prevent a precise assessment of the unlikeliness to pay of customers. While moratoria and other support measures have provided banks and borrowers with vital breathing space as the social restrictions were implemented, banks should act early to avoid these measures generating damaging cliff effects when they simultaneously expire. This would risk producing exactly the sort of procyclical dynamics that we managed to avert at the start of the shock. Higher stage 2 classifications highlight a higher incidence of credit risk being identified among moratoria, but stage 3 classifications, so non-performing loans basically, are still comparable to the levels of the broader loan book. The profitability of supervised banks is projected to rebound only moderately in 2021 to levels that are still low with a bleak earnings outlook. The provisioning needs that have so far been acknowledged as a result of the pandemic represent the main negative driver in the outlook. As the winter developments are likely to lead to the need to further provisioning, credit risk will weigh further on structurally low profitability of the euro area banking sector. Pressure to address existing vulnerabilities such as overcapacity in the banking sector and lingering cost inefficiencies is likely to intensify. Increasing competition from non-banks and the market shift towards greater digitalization brings opportunities, but also increased risks, including IT system deficiencies, cybercrime, operational disruptions in the banking sector. One way to remove excess capacity and restore European banks as attractive investment propositions is through consolidation. We have recently seen some movement here. With our guide, we set out to clarify our approach and show that it is supportive of well-designed and well-executed business combinations. Consolidation may help address structural problems of overcapacity and depressed profitability and could be particularly beneficial in the aftermath of a recessionary shock. In the experience of other jurisdictions, for instance, the US, following the great financial crisis, it's clear that consolidation may help to reduce excess capacity. There is a silver lining, though. So the fact that drawing on the lessons learned during the pandemic and also the effectiveness of the move to remote provision of services and the increased productivity that several banks notice in this period, banks are becoming more alert to the need to enhance cost efficiency and invest in new technologies. Digital technologies not only help banks provide a better service to their clients, they also tackle cost efficiency and transformation issues. Banks using digital technologies to serve their clients remotely may be able to operate fewer branches, and in a similar vein, banks may draw on the experience they have gained from managing their staff and premises during the lockdowns. As remote working seems to have proved successful in most cases, banks should consider reviewing their staff and premises policies with a view to increasing cost efficiency. Several significant banks are engaged in transformation projects, which, if successfully executed, might address concerns about the long-term sustainability of their business model. As credit risk from the pandemic has not yet materialized and some concerning practices were identified, scrutiny of credit risk will remain a priority moving into the new year. If banks follow up on our 2020 letters on credit risk and qualitative measures under the SREP, the credit risk picture will clear up in 2021. This in turn will allow us to get a better picture of banks' capital trajectories after months of heightened uncertainty and impaired capital projections ability. Capital buffers have been made available due to front-loading of P2R composition, while our SREP requirements and guidance in total capital remain stable. This full buffer flexibility is at the bank's disposal until at least the end of 2022, so they can absorb the cost of risk of the pandemic in 2021. Banks should not let concerns about the supervisory reaction to their use of buffers stop them from appropriately measuring credit risk. Let me also stress that with asset quality becoming more visible and capital projections more reliable, ECB Banking Supervision will, as announced last December, return to ordinary, old normal supervision of dividend distributions and share buybacks in 2021. On the structural side, we expect banks to continue along the path of structural transformation that the COVID-19 pandemic has prompted, both in terms of cost efficiency relating to staff and branch management and in terms of technology adoption. These two avenues will help restoring acceptable levels of profitability. And in addition, as I said earlier, further consolidation projects where these can be prudently framed and planned could help strengthen the long-term sustainability of banks' business models. We will keep a special eye on governance issues as the number of outstanding measures from last year's REP cycle means this is still one of our greatest concerns. And so thank you very much for your attention, and I now look forward to answering your questions.
Thank you very much, Andrea. So before we start the questions, just let me remind you of a few things. Please click the icon of the raised hand to ask a question. I see that some of you have already done that. Then when we call upon you, can you please turn on your camera so then we can see you and have a bit of a virtual interaction at least here. And please keep your questions to a maximum of 2 per turn. So then we will go with that. We will go to the first question, and we will call on Francesco Canepa from Reuters. And after Francesco, we will go to Nick Comfort from Bloomberg. So Francesco, can you please turn on your camera? Yeah. Yes. Thank you.
Good morning all. Francesco Canepa from Reuters here. My first question regards dividends. So the supervisory dialogue about that should have already started. How is that going? How compliant are banks with your recommendation? The second question is about the 2 new countries in the banking union, Bulgaria and Croatia. You guys have started supervising some banks there. How is it going? And in particular, have you found anything that makes you worry about a new Latvia? And I'm referring to AML concerns, given that these countries border with what used to be called the Eastern Bloc. Thank you.
Thank you. Well, on dividends, yes, you're right. We just received the feedback from the banks according to our requests, and there is some dialogue ongoing. I would say that in general, significant institutions are all online to comply with our recommendation. And there are some discussions which are mainly referring to the aggregates, the definition of the aggregates that have to be used in the calculation of what we call the double guardrail, let's say, for setting the constraints to dividend distributions. But the banks are giving positive feedback on their intention to comply with the recommendation. The cooperation with Bulgaria and Croatia, so the participation of Bulgaria and Croatia in the banking union is going very smoothly. We have included them in their banks in our regular monitoring, following the comprehensive assessment that was completed last year. On AML, let's say, of course, we have our regular, let's say, way of factoring AML concerns in our process, also in the SREP process, and we will rely also for these banks with enhanced cooperation with the local AML authorities to get access to all the information which is relevant in order to enable us to be on top of potential issues, especially on the side of on the prudential side, so on the aspects of internal controls and governance. Thank you.
Thank you. So next one is, as I said, Nick Comfort, and after Nick, we will go to Elisa Piazza from Class CNBC. So first, Nick, please.
Hi, good morning. So I have two questions from my side. The first is on liquidity waivers. Mr. Enria, what's your message to banks? You and your colleague Edouard Fernandez-Bolo have done a lot of groundwork in terms of trying to reassure national competent authorities about sort of the I don't want to say the word guardrails, but the system, the fact that we live in a European system. Still, it seems like national competent authorities aren't quite on board yet. So what's your message to banks? Should banks bother applying for liquidity waivers this year, or is it something which is more longer term? And then the second one is on, since Francesca already asked about dividends, maybe about the 9 banks that are indeed tapping their capital buffers. Maybe you could tell us a little bit about how that has been seen from investors, any anecdotal feedback on that, because I believe there was some reticence on the side of banks to dip into their capital buffers. What's the experience been with them? Have people lost confidence in them, or are investors all right with it? Thank you.
Thank you. As to liquidity waivers, again, I mean, we have a setting within the legislation which is, in my view, pretty restrictive, but still we try to give guidance on ways in which, let's say, we could strive to manage, also from the supervisory perspective, in a better way, the management of liquidity on a group-wide basis within the banking union. So banks which are interested in applying for liquidity waivers, of course, have the right of doing so under the current legislation, and we will carefully try to address their concerns and look into their requests pretty attentively. Of course, you know that this issue of moving the banking union to become a true domestic market for European banks is not something that will happen overnight. We know that the absence of a deposit guarantee scheme, of a European deposit guarantee scheme, is still a concern in a number of quarters and will impede a fast move in that direction. But I think there is, as we mentioned also in the paper with Edouard that you referred to, I think we should make a try to make the current framework work at its best as far as we can. As to the 9 banks, again, I wouldn't put a lot of emphasis. Actually, the very few banks have dipped into the buffers and have slightly dipped into the buffers, most of them. There has been an extensive concern that buffers were not being used, that there was a lot of reluctance of banks to use buffers. As I said in my remarks, let's say we need to assess this once the losses, let's say, once the deterioration of asset quality, the defaults start to materialize. In that case, we will have to see whether banks will feel that they can freely use the buffers without being subject to market stigma or not. I hope this is not the case, and again, our recommendation to banks, as I say today, is that they should actually use the buffers because that's the purpose they've been built for.
Thank you very much. So as I said, we go to Elisa Piazza now, and then after that we will call on Paul Davies from the Wall Street Journal. So Elisa?
Good morning.
Good morning.
Good morning. You spoke about consolidation, bank consolidation. I mean, now in Italy, there's a new CEO at Unicredit, Andrea. Would the hypothetical consolidation between Unicredit and Monte dei Paschi di Siena be positive for the stability of the Italian banking system?
Well, as you can imagine, I cannot comment on a specific case. More generally, I don't think it's the business of supervisors to let's say, organize weddings between banks and to organize business combinations. I think that the point on concentration, on consolidation that we have made strongly is that there is a concern on business model sustainability across several banks in the banking union, and consolidation could be an avenue to address these concerns and put business models on a more sustainable path. And we recently issued a guide to clarify our supervisory expectations. I mean, I think there was a misunderstanding on the way in which the ECB was looking into consolidation. So the impression that we would have increased capital requirements as soon as a business combination was proposed to us. We clarified that this was not the case. We clarified also the treatment of the so-called badwill, which is particularly relevant now, having seen the depressed valuation of European banks. So I think that we provide clarity, and we see that some projects have taken shape and have developed recently. And we do hope that this process will continue, because we think it's crucial to address the excess capacity problems that we have identified since several years.
Thank you very much. By the way, can I remind those who have already asked questions to sort of unraise their hands on the WebEx, because it makes it easier to follow who's next. Thank you. Now we go to Paul Davies from the Wall Street Journal, and after that to Jack Schicker from MLEX. So Paul, please.
Hi. So I'd like to ask about underwriting risks in the leveraged loan market. Are you concerned about aggressive multiples or capital structures there in general? And if so, will you address this in any way in terms of extra capital charges for banks arranging or buying into some of the most aggressive leveraged loan capital structures?
To be honest, we have been focused on the risks in the leveraged loan markets for a while. We have seen that this market has developed strongly since 2016-17, and we have seen that in their search for yield, also European banks started venturing to this market in a quite significant way. In 2017, we issued guidance for our banks, for our significant institutions, to let's say, only exceptionally engage in highly leveraged transactions, and to limit the exposures to so-called covenant-light transactions. And we have seen, nonetheless, notwithstanding our guidance, that the exposures to highly leveraged transactions, so where the exposure, the debt is more than 6 times the EBITDA, has represented, if I remember well, around 60% actually of the exposure. So, and also the relevance of covenant-light transactions is still quite high. So we have intensified our pressure on banks, also looking into their stress testing capability with reference to these exposures. And indeed, we are asking for, very attentive risk management and containment of risk in these areas, where we don't see adequate responsiveness of the banks to our pressure, to our supervisory pressure. Of course, we can reflect our dissatisfaction also in our supervisory recommendations, and eventually in the capital charges for the banks.
And a follow-up, has any bank had any extra capital charges already because of this?
Well, we have done a number of on-site inspections which have focused explicitly on leveraged finance, and in many cases we have asked for adjustments in the prudential treatment of these exposures, which has indeed reflected into capital impact.
Thank you.
Thank you very much. So next one is Jack Schickler, and after that we will go to Victor Mendes from Central Banking, if I'm correct. So Jack, do you have a comment?
Thank you, Mr. Enria. You said that many banks' business models were not reliable. That sounds quite a serious problem looking ahead. But you also said that the ECB's job isn't to arrange marriages between banks. So what your qualitative recommendations to these banks that are troubled actually involve, and do you have confidence they'll be heeded? And a quick second question, I think you said that banks were artificially manipulating their internal credit risk models, that they'd change their models to artificially. Do you have, what can you do in that situation? Does the ECB have enough powers to act in that area?
I'm not sure I got your first question. It's on business model, but I missed some parts. So if I don't reply accurately, please come back to it. On business models, indeed, we are. It's one of the key pillars of our SREP assessment. No, the sustainability of business model, also because ability to generate profits, ability to attract investors is the first line of defense for banks in case of a shock. And at this moment, at this juncture, we think that if you look at the bank's valuations and the depressed profitability, which is now, we have the return on equity below cost of equity for the large majority of our banks. This is a situation that needs to be remedied. The way in which this needs to be done is by, let's say, more decisive action on a number of drivers. We made an interesting analysis already, I think, 3 years ago on banks' business models, in which we came to the conclusion that banks which had stronger business models were those which had a strong capacity in terms of strategic steer. So the governance aspect is very important. The investments in new technologies, digital technologies in particular, was a second most important driver. Of course, the asset quality was a third element that was very relevant, and cost efficiency and reliance on expensive branch networks was the other ingredient. So these are the element of the puzzle. We are putting a lot of supervisory pressure, increasing supervisory pressure on banks to take all these challenges. And as I mentioned in my remarks, we noticed that the pandemic, to some extent, has been a catalyst for banks to bite the bullet and start addressing in a more radical way these weaknesses. So we encourage banks to move further in this respect. Now, on the credit risk models, I mean, manipulation is a big word, right? What we are saying is that what we notice is that there is much less. They have flattened in their models the responsiveness of their probabilities of default to decreases in GDP. Now, there could be good justifications for this. I mean, it's the first time that we have a recession which is at the same time so sudden and so harsh, but at the same time also so much strong in the reaction of monetary and fiscal policy to support a fast and strong recovery. So there could be justifications for this adjustment, but it is so massive that we think we need to look more into that. The key point on which we have been zooming in recently is the ability of banks to produce reliable projections on asset quality and therefore on capital, and this is where the focus of our teams will be particularly centered in the coming months.
Thank you very much. So we go to Victor Mendes of Central Banking, and if you have a camera, can you please turn in camera? It would be really nice to see you. After Victor, we go to Andrea Skröner from Handelsblatt. So, Victor?
Hi, good morning. Thank you very much for taking my questions. My first question is in relation to monetary policy impact on the banking sector. Yesterday, we've seen reports of governing council members stressing that rate cuts is still an option that they are considering. I was wondering how do you assess the resilience of the banking system, especially going forward in 2021-22 to still lower interest rates. And my second question is in relation to public debt. We know it's going to keep rising in 2021. In this context, how urgent do you deem the debate about maybe reforming the Basel III framework, introducing risk weights for sovereign debt held by banks? Thank you very much.
Thank you. Well, the low negative interest rate environment, of course, has exercised a negative effect on interest margins, but at the same time, it has exercised a positive effect on lending volumes. And also for some time also on the trading book asset, and of course it's very difficult to look at the counterfactual. No, so having a very accommodative monetary policy, as I mentioned, has been instrumental to have to accompany a path for fast recovery and to avoid a massive deterioration of asset quality already up to now. So there have been a number of very positive effects on banks from the current monetary policy stance, but of course there is also the effect on interest margins, which is relevant. The stress test that we will run together with the EBA will also let's say try to capture this aspect of the low for longer type of interest rate environment, I understand. With reference to the exposure, the sovereign exposures, let's say, of the banks, I understand this is the main focus of your question. Of course, so far the risk embodied in these exposures has been relatively muted. The spreads have remained pretty compressed. Banks have increased their exposures, and especially, of course, a number of there is also an indirect exposures through the guaranteed loans that have been granted in the response to the pandemic. So there is an increase in the exposure. as we have always said in the past, and this, by the way, my strong conviction, the point is not so much the relevance of the size of the exposures, the point is the concentration of the exposures on the domestic sovereign. So a point from the supervisory perspective that would be very much welcome is increased diversification of these exposures. The debate in Basel has not at the moment led to any step in the direction of fixing this issue from the regulatory perspective, so it's something that in any case we keep monitoring from the supervisory perspective.
Thank you very much. I also hear that we're having slight difficulties with the video, so maybe in some instances you are turning on your camera and we can't see you. Apologies for that. Next questioner is Andreas Gröner from Handelsblatt, and after that we will go to to Milano Finanza, to Francesco Ninfole. So Andreas Gröner, please.
Yeah, good morning. I have a question about deposits. Analysts argue that deposits have never been less valuable than now, as interest rates will stay low or even below zero for a couple of years, and central banks are drowning the financial system with liquidity. My question is how banks should react to that, in your view. Should they avoid to attract too many deposits, or should they do they have to increase their efforts to pass on negative interest rates even to retail clients with lower deposits? And maybe for the big picture, do you think in general that retail deposits are less important for the stability of banks than they have been in the past?
Well, thanks for the question. In general, let's say, we are, as supervisors, we are not particularly focused on the concerns we have with deposits is when they become too volatile, no? And that's not the case. That's not the case at the moment. Of course, we understand that banks in the current interest rate environment, attracting deposits means that there is a limited margins, no, that could be earned on those deposits. But still, let's say it's up to the banks to decide their own commercial policies. Also, in terms of pricing, that's not something on which we would express any specific assessment. So our key point is to make sure that deposits are sufficiently protected, and especially, let's say, the aspects that was more destabilizing in crisis of the past is when you see a materialization of credit risk problems and the deposit starts moving. And this is one of the stronger arguments in favor of having European deposit insurance schemes, which ensure that whatever the value is, the value of €1 of deposit is the same across the banking union. So I think that's the most important focus I would have on the topic. Thank you.
Thank you. Thank you. Next question goes to Francesco Ninfole, and then after that we go to Hannah Brenton of Politico. Francesco, please.
Good morning. Can you hear me?
Yes.
Thank you for taking my questions. I have two questions for Mr. Enria. The first about SREP requirements. Could you clarify when they will come back to normal, so they will not be pragmatic anymore? And second question about bad bank. You proposed a European asset management company. What do you think about the European Commission's proposal on national bad banks? Do you think they will be useful in cleaning up banks' balance sheets, and do you expect to see them operational in the short term? Thank you.
Thank you. On the SREP requirements, we will start soon, actually, with the SREP 2021 cycle. So at the end of this year, we plan to complete the new cycle. The stress test that we will soon start together with the EBA will lead to also the determination of the Pillar 2 guidance as well. So at the end of the year, there will be new SREP requirements and guidance that will be defined, and that I hope we will discuss again next year in January with individual banks' results as well. We have said, of course, that we will give time to the banks to rebuild the buffers, so at least until the end of 2022. We said more precisely that we will not start the rebuild of buffers before the capital depletion generated by the crisis is over. So there will be an issue of deciding the appropriate timing and fine-tuning the appropriate timing according to the development of the coming months. But in any case, we said clearly not before the end of 2022. So that's a little bit the picture for the SREP, for the P2R and the P2G. In terms of the issue of asset management companies, I am pleased that the Commission took up the topic of asset management companies in their communication on non-performing loans and on how to deal with the problem. I think that the paper was useful to keep the subject on the table. Let me be clear with you. I mean, I hope that there will be no need for asset management companies. So I hope that the relatively rosy projections that we have seen also by market analysts will be the right projections, and that maybe we have been a little bit too gloomy in our assessment of credit risk. But indeed, if we move in the direction of a significant increase in non-performing loans, I think it is important that we start making some preparations in that respect. This dilemma, European versus national AMC, I mean, if you ask my personal opinion, I've never been convinced by the arguments against the European AMC. There are people saying that the non-performing loans are very heterogeneous across countries, could not be managed on the European level. What I see is that the major private buyers and managers of European distressed assets are actually in many cases pooling the servicing and the management of these assets for the whole area. So if this can be done already by private buyers, I don't see why an asset management company could not do the same. There have been concerns that if there are forms of state aid, having a sort of mutualization of losses across member states would be politically very difficult. But in my proposal, I've always mentioned that you can very well engineer a scheme that does not entail any mutualization, that reallocates potential losses. And by the way, asset management companies, if well designed, should not generate losses in the long term, but could be reallocated to individual member states. So I'm not convinced of the arguments against European asset management companies, but I think also national asset management companies could be useful. I understand that the idea of European initiatives is not getting traction. That's fine. Having national asset management companies would also be a positive way forward if we go into a situation in which bad loans start piling up. What I mentioned in my contribution to the debate is that if we go to asset management companies at the national level, in the banking union at least, it would be important to have some common criteria which ensure that the speed and effectiveness with which banks can clean their balance sheet is equivalent, irrespective of the country, the member state where the bank is headquartered. So that has been, and I focused in particular on the issue of pricing and funding. These two aspects, in my view, are crucial to provide an important European component and to put banks across the banking union on a level playing field to deal with the issue.
Thank you. So next we go to Hannah Benton of Politico, and then after that to Markus Frühauf of the FAZ. Hannah.
Hi there. Thank you for taking the question. I just wanted to ask about Brexit. Are there any outstanding concerns for Eurozone banks, and have enough staff and resources been moved into the EU at this point?
Thank you for the question. I think that on Brexit, let me say first of all, let me congratulate the negotiating teams that have managed to conclude a difficult deal at the razor edge at the end of the year. I think this has been very, very positive. As far as the banks are concerned, we have had a very clear and engagement with the banks. We have defined since a long while their target operating model, so where we expect them to be at the end of the transition when they move their business with European customers to the European Union. My impression is that there are still some sticking points in terms of especially the level, quality of the management in particular, which is being moved to the European Union. I think that one key issue for our attention is that we have sufficient strategic and risk management capacity onshore here. And we're not there yet. For some banks we are, but not for all the banks. So that's an area on which we are focusing a lot of our attention. The reliance on back-to-back booking and on outsourcing is another area which is of great attention for us. But there has been a very good engagement with all the banks. They know what we are asking of them, and we have seen significant progress also in the final months of last year. So we are encouraged that we will get to the target operating model pretty soon.
Thank you very much. We still have quite a few number of people who want to ask questions, so we'll try to get most of them in. But let's see, Markus Frühauf of the FAZ, and after that, Edouard Lederer from Les Echos. Markus?
Good morning, Mr. Andrea. I've got two questions. First one, would European banks more profitable without negative interest rates? And the second one, what do you recommend in terms of remuneration policies? Thank you.
Well, on the first question, I think I addressed it to some extent in a previous answer. The negative interest rate policy has, of course, a negative effect on the interest rate margins for banks, but it has also a positive compensating effects on volumes and on market valuation, on the trading book, and especially, which is very difficult to quantify because we don't have the counterfactual, it has had an important effect in terms of avoiding an even harsher recession and a much more, let's say, concerning deterioration in asset quality. So all in all, let's say, it's difficult to assess the impact on profitability. In terms of, sorry, the second question, Connie, was
remuneration.
On remuneration. On remuneration, we have been quite. We have not been as clear as we have been on dividends, so we have not put specific limits because there are already quite detailed rules on remuneration. but we made a clear recommendation to banks to exercise extreme moderation in this extraordinary year, especially by relying also on, let's say, on payments in instruments or let's say, delayed compensation. So it's clear that it's an area in which we are also engaging quite a lot with banks.
Okay, thank you very much. Edouard Lederer, and then after that, Martin Arnold of the Financial Times.
Yeah, hello. So can you hear me?
Yes.
Yep.
Okay, perfect. So I have two questions for you. My first is regarding credit risk. I was wondering, is there a more specific focus on corporate lending versus house lending? It has been reported that you have asked banks for more details in Germany and in France. And I wonder if you had specific concerns for those two economies. And my second question is about staff policies. You mentioned the fact that staff policies at banks could be changed because of the context we all know of. Do you expect job cuts in the European banking sector in the coming months and years? Thank you.
Well, on credit risk, it's not as easy as corporates versus households. This is a very specific crisis, a very peculiar crisis, which has a very differentiated impact across different set of counterparts. So in the corporate sectors, there is a very diverse impact according to sectors. There are sectors which have been heavily hit by the crisis, and other sectors which have been instead even benefiting from the distancing measures and the behaviors that these distancing measures have triggered. Also, we have to keep in mind that the very significant fiscal support measures that will deploy also thanks to the Next Generation EU package in the coming months and years might have also a differential effect on different sectors. There could be sectors in particular linked to let's say, digital economy, to sustainable investments, to green and environmental friendly investments that might be benefited from this fiscal expansion, and others that could instead be less on the receiving end of this support. So there is a very differential effect within the corporate sector. Also within households, let's say, we have not seen a lot of effect, for instance, on traditional residential portfolios, but instead, in terms of lending for consumption, there have been some segments in which we have identified enhanced risk. So there is a lot of differentiation, which has made, let's say, the traditional modeling and understanding of the credit risk environment quite difficult for us as supervisors, and that has been a point that I've raised also in my remarks. On staff policies, well, there are banks which have the cost to income on average is very high. If I remember well, is in excess of, is around 65-66%, and that's been stable for some time now. And it is clear that there are banks which have a cost to income ratio which is way too high. I mean, for some very close to 100%, which means that they are not, they're basically not generating sufficient capital. So for these banks, for this tail of banks, indeed, let's say efforts on the side of cost reductions and staff costs, so staff cost cuts also will be absolutely necessary.
Thank you. We're running a little bit over time, so we are taking the last question now. As I announced, should be Martin Arnold from the Financial Times. Martin.
Good morning, Andrea. Thank you for letting me ask a question. I have two, in fact. One is on NPLs. the extreme case that you gave a few months ago for NPLs was there could be 1.4 trillion euros of extra NPLs. What is the base case? Because apparently we've already heard from the ECB that it's looking more like it'll be the base case than the extreme case. It'd be good to know what your base case is on that. And also, you mentioned about moratoria, debt moratoria. Is that your main area of concerns, that these loans that are subject to forbearance and moratoria could transform into NPLs? And second question is on dividends, and how much do you expect the banks to pay out in dividends this year? Thank you.
Well, on NPLs, let's say I wouldn't give any specific figure here. I mean, I think that we wanted to put on the table in July, when we made our vulnerability analysis, the possibility that in an extremely severe scenario, the deterioration of asset quality could have been much higher than the banks were at the time estimating with their, in our view, excessively mild projections. So that was the main point. Now the 1.4 trillion case is, to be honest, less likely right now. The probability of that scenario has reduced according to the most recent forecast. We are starting in a short while a new stress test that will be the tool with which we will try to estimate in a more accurate way the potential deterioration in asset quality. Moratoria is a peculiar area of concern because of course, the delays in payments are one of the main indicators the banks use to classify their customers. And moratoria generate a sort of blindness, lack of visibility in terms of payments. That's why since the very beginning, since March last year, we have told banks that they should have developed additional indicators to try to understand the quality of their customers and to see through the moratoria to be able to reclassify customers if they are unlikely to pay back their loan. And we have not seen a lot of that happening. So that's an area on which indeed we are focusing a lot of our attention. It was one of the areas of focus of our letter in December. I must say that also the flagging of forbearance cases is something on which we were puzzled. We have not seen sufficient loans being reclassified as forborne, and we were concerned because the indicator showed that this was not reflecting the reality on the ground. So these areas are areas on which we are collecting information now from the banks. We asked banks to give us replies to our letter in December by the end of January, and we will analyze carefully these answers. On dividends, it's a bit early days. I mean, we just received the feedback from banks, and with some of them we are still negotiating and discussing how the aggregates should be calculated and the like. But our very, very preliminary estimate is that the ballpark should be what we basically expected, so slightly above 10 billion, around 10.5 billion, maybe 11 billion in that region. So that's what we expect, in full compliance with our recommendation.
Thank you very much. Thank you, Andrea and Ria, and thank you for everybody for joining us today. I hope it worked well with the technical parts here, and we'll conclude the press conference here. As I said, the statement with the charts are published on the website if you want to have another look. Thank you very much, and have a good day.
Thank you. Bye-bye.